Good evening, students. Welcome to the session. So today we are going to revise the topic of NR taxation. So I hope in the last class I told you that you should revise and come for that particular lecture. I hope you have revised because we'll be quickly going across the questions and the revision for that. So with that note, let us just quickly start with it. So first of all, under the NR taxation, you have to tell me how do you determine the residential status of the individual here in India? Yes. How do you determine the residential status of the individuals? Yes. What is the criteria for deciding the residential status? Yes, Samnithan. So we decide the residential status of the individual on the basis of number of days of stay, isn't it? But what are the number of days of stay for an individual? Yes. Under section 6, 1, a person or an individual is said to be a resident in previous year if he stays in India for greater than equal to 182 days during the relevant previous year, or he has been staying in India for more than 60 days in the relevant previous year and more than 365 days in the 4 years immediately preceding the relevant previous year. Yes, Samnithan. Right? So either of these two conditions are satisfied, a person will be said to be a resident in India. This is a cumulative condition, but you have to satisfy either A or B. Now, the stay in India means will include the stay even in the territorial waters of India, which is 12 nautical miles, isn't it? And it is not necessary that the stay has to be continuous. You have to say the stay during the previous year. And for counting the number of days of stay, you have to see both the date of departure as well as the date of arrival. You need to both consider. Are we clear? But with this 60 day, the 60 day has an exception. So this condition B has an exception wherein you consider instead of 60 days, 182 days, in which cases, so condition B is not applicable in which situation? Yes. Condition B, exception. What are the exceptions? Yes, Leela. Yes, Ruchita. Crew of Indian ship. Very good. Yes, Samnithan. But what is the entire condition? Employment outside India. Yes, but what is the entire condition? Yes, Leela. Yes, Ruchita. Yes. Indian citizen who leaves the India as a member of crew of Indian ship. So not every crew of Indian ship Samnathan, but Indian citizen who leaves India as a member of crew of Indian ship or an Indian citizen who leaves India for the purposes of employment outside India. Yes, in those cases, 60-day condition is not applicable. Or an Indian citizen or a person of Indian origin who, being outside India, comes on a visit to India during the relevant previous year, if he has the income from the Indian sources not exceeding rupees 15 lakh. Now, what is the difference between the Indian citizen or a PIO? Yes. Who is a PIO? Yes, Suchita. Who is a PIO? PIO is a person if he or either of his parents or grandparents were born in undivided India. Okay, so that is the PIO. Students, please revise and come for the lectures, because if you do not revise, you will feel like you're not able to understand anything in these lectures. Because these are supposed to be revisionary lectures to help you solve the doubts, to help you understand your concepts or strengthen your concept and to solve the questions. But if you look these as a normal lecture, these are not going to be taken in that way, because in one lecture we are going to end the NR taxation entirely, whereas in the normal lectures we take 3 lectures for completing the NR taxation. So you have to participate so that you can clear your mistakes. Okay, if you do not participate, if you do not give the answers and just listen to this, you are not going to benefit out of these lectures. Okay, students, so please, I request everybody to participate, whosoever is present in the lecture. Fine. Now, there is one more exception for 60-day rule, which is instead of 60 days, we will consider 120 days. In which case we will consider 120 days? Yes. In which case we will consider 120 days instead of 60 days. Indian citizen or PIO who being outside India comes on visit to India where the total income from the Indian sources is more than rupees 15 lakh. Yes, Leela, very good. Where the total income is more than 15 lakh. So Leela, if you write like this, Indian citizen and a PIO who being outside India comes on visit to India. It is not that for every Indian citizen and PIO where the income is more than 15 lakh. And the income from the Indian sources. Indian sources, when we talk about, is income which does not accrue or arises outside India. Okay. Or which is not deemed to accrue or arise in India. So income basically which accrues or arises in India, or which is deemed to accrue or arise in India, that is the income from Indian source. Okay. Now, how do you determine the period of stay for an Indian citizen who is a crew member? So, in case of foreign bound ships, where the destination of voyage is outside India, there the CBDT has issued a notification, has inserted a rule 126, which says that in case of an Indian citizen who is a member of crew of a ship, right? We will not include, while counting the number of days, we will not include the period from the date entered into the discharge certificate when he joins the ship and up till the date he signs off from the ship. So in the ship, they prepare a discharge certificate, right? So in the case of a ship which is going from a port in India to a port outside India, or from a port outside India and coming to India, in that case, the period between the period between the date when he enters the ship and when he leaves the ship is going to get excluded. Are we clear? Next, we have the concept of deemed residency. What is the concept of deemed residency? Yes, what is the concept of deemed residency? Indian citizen, sorry, income greater than 15 lakh, not taxed anywhere. Yes, Indian citizen. Very good, Leela. So an Indian citizen having the total income, not from the foreign sources. Basically, excluding the income which is accruing or arising outside India or deemed to accrue or arise, not in India. If this income is more than 15 lakhs, he would be deemed to be a resident in India if he is not liable to pay tax in any other country by reason of his residence in that country. So he's a resident of some other country. However, he is not liable to pay tax in that country. So who is a person who is not liable to tax? What is the meaning of liable to tax? Liable to tax means that there is no income tax liability on that person under the law of that country at the moment, or who has been exempted from such liability under the law of that country. So this deemed resident can only be an Indian citizen. Now, irrespective of whether he has not been present in India even for one single day, he can still be considered as a deemed resident of India. Are we clear? Fine. Now, once a person is a resident, you need to see whether he is a resident and ordinary resident or a resident and not ordinary resident. What is the difference between ROR and RNOR? What is the difference between the ROR and RNOR? Scope of income differs. Yes, Leela, very good. So what is the scope of income of ROR? What is the scope of income of ROR?
It is income received or deemed to be received in India, and income accrued or deemed to be accrued in India, and
Yes,
which and income from business controlled from India or profession set up in India.
that is for RNOR. For ROR, global income is taxable in India. Income accruing or arising, whether in India, whether outside India, income received in India, everything for ROR is taxable. For RNOR, income accruing or arising in India or deemed to accrue or arise in India or income received in India and income accruing or arising outside India from a business controlled or profession set up in India. And for the non-resident, income accruing or arising or deemed to accrue or arise in India and income received in India. So what is the difference between RNOR and NR? Is this category C, which is income accruing or arising outside India from the business controlled or profession set up in India. That is the difference between the two. Are we clear? Okay. Now, who is ROR? When a person can be said to be ROR? When is a person said to be ROR?
If he is resident out of 10 previous years, 2 years,
Correct. Very
and
good.
he is resides in India for 730 days or more in the
In
last 7
7.
years.
Very good. So, an individual can be a resident and an ordinary resident only when he satisfies both the condition. If this individual has been a resident in 2 out of 10 previous years, preceding the relevant previous year, or he has been staying in India for more than 730 days in the past 7 preceding years to the relevant previous year. In the case of a person who was into the exception of that an Indian citizen or PIO visiting India and who has the total income of more than 15 lakh from Indian sources, this conditions, these conditions do not apply. For him, he will be an ROR. He will always be an RNOR, and only if he has the stay greater than 120 days and less than 182 days. If he has stayed more than 182 days, then he will be ROR. And a deemed resident will always be RNOR. For him also, you don't check these conditions. So for two categories, deemed resident and a person, individual who is an Indian citizen or a PIO who is visiting India, having the total income from Indian sources more than 15 lakh, is RNOR if it stays more than 120 days and less than 182 days. Are we clear? Now coming to the HUF. How do you determine the residential status of the HUF? Yes.
If management and control is wholly or partly in India, then resident.
Correct. Very good.
If wholly outside India, then it is non-resident.
Correct. So for HUF, if the control and management is wholly or partly in India, then it will be called as a resident of India. What is the control and management? How do you decide what is control and management? Control and management refers to who is taking the key decisions of the HUF, the central control and management, and not the day-to-day decisions, which means the key operational decisions. Where is the head and brain of HUF? Okay, so that is important. And HUF can also be ROR or RNOR depending upon the
Karta's
yes,
residential status.
Karta's residential status. So depending on the Karta's residential status, the HUF can be ROR or RNOR. Are we clear? Okay. Now, next is for the partnership firm, AOP, BOI. Again, what is the residential status? If their control and management of the affairs is wholly or partly in India. Partnership firms, AOP, BOI cannot have ROR or RNOR status. Okay. Next is about the company. When is a company a resident in India?
When the poem is in India.
When the poem is in India or it is an Indian company. Does it mean a company is a resident, so it will become a domestic company? No. Domestic company means an Indian company or a foreign company which has made the arrangements for declaration of dividend in India. It doesn't mean that once a company is a resident company, it becomes a domestic company. A resident company is different from domestic company. The residential status of the company is important for determining the scope of total income. For determining the tax rate of the company, you need to identify whether it is a domestic company or a foreign company. So even if a company is a resident company, but it is a foreign company, which is a resident company because of it has a poem in India, in that case, it will still have the tax rate of, what will be the tax rate for a foreign company which is a resident in India? Yes. What will be the tax rate? 35%. Very good, Leela. Okay. Now, how do you decide what is the meaning of poem? Poem here means that where are the key management and commercial decisions that are necessary for the conduct of the business are in substance made. How do you decide the poem of the company? Where is the poem of the company? So the CBDT has given a circular of 2017 as a guidance for determining the POEM. What is the question you need to ask? Whether the company is engaged in active business outside India. ABOI test. What are the 4 tests under the ABOI? Yes.
More than 50% assets are passive income. Passive income is more than 50% of the total income. And less than 50% of the assets are situated in India. Less than 50% of employees are situated in India. And their payroll expenses are less than total payroll expenses.
Less than 50% of the total payroll expense. Very good. So, a company shall be said to be engaged in active business outside India when the passive income is less than 50% of the total income. What is a passive income? What is a passive income?
Where both purchase and sale is with associated enterprises.
Correct.
And income from royalty, dividend, extra.
Yes. So, passive income will include royalty, dividend, capital gains, interest, rental income. So, meaning all your income other than your business income, other than the income from the core operation, that is the passive income. It will also include the income from the transactions where both the purchase and sale is to and from the aim. So let's say, for example, if I'm purchasing from an associated enterprise and selling to another associated enterprise, that will be included. But if I'm purchasing from A and selling to the customers, it is not included. Or if I'm purchasing from my suppliers and selling to my associated enterprise, that is not included. Okay, so that is the passive income. And this income will be as per the books of accounts or the tax records in that country, not Indian income. This is the income which is there of the company in that country. Okay. Second is less than 50% of the assets are situated in India. So you need to take the value of the assets in that country. If these are depreciable asset, you will take the value as per the return. If it is non-depreciable asset, then you will take the value as per the books. So these value of the assets in India should be less than 50% of the total assets. Less than 50% of the employees are situated in or are resident of India. And the payroll expenses on such employee is less than 50% of the total payroll expenditure. Payroll expenditure will include the cost of salary or the pension cost, all the costs which are borne by the employer. Okay, and you have to take the average values for all of this at the opening and the closing date. So this is how you decide the ABOI test. Now, once a company has satisfied the ABOI test, then the POEM shall be presumed to be outside India if majority of the board meetings are held outside India. But where a company does not satisfy the ABOI test, then you need to ask 2 questions. What are the 2 questions you will ask? Where are the key decisions being taken up? And who is taking those key decisions? Okay. So if a company is satisfying the ABOI test, you will have a presumption created in favor of company that if the majority of the board meetings are held outside India, the POEM is outside India. Of course, if the facts demonstrate that the decision making is being taken up by some Indian resident or Indian parent company and not actually by the board, then the POEM will be presumed in India. And these POEM guidelines are not applicable to companies having a turnover or gross receipt less than equal to 50 crores. Are we clear? Now, if a company is not satisfying the POEM test, then you need to ask these questions. Where are these key decisions taken up and who are taking those key decisions? Are we clear? So for that, you need to look at where the board meetings are happening, where the board of directors are taking these decisions. Just by formally holding the board meetings is not sufficient to conclude that the poem is there. So you need to see who is actually taking the key decisions, like, where to open up a new plant, which areas do we serve, which kind of products should we operate in. That are the questions that, if somebody is taking those decisions, then, that is the place where the poem is. For example, if we talk about our industry, right? If, I have a global firm, global accounting firm. Now I am sitting in India and taking the decisions, okay, we should serve US, Singapore, Australia. We should only focus on, accounting and let's say, CFO services. So I am the person who is taking these key decisions, not the day-to-day decision like, who has to be hired or, which office do we take it on lease. These are day-to-day decisions. But the key decisions which help company to operate. Who is that person who is taking that decision? And where are these decisions being taken? That is important. That is where the poem is. So just holding a board meeting, let's say I go to Singapore and hold and make a board resolution, make the minutes and say that okay, these decisions were taken in Singapore, that shall not be the poem. The poem shall be where the decisions are in fact being taken up, which can be other than the formal place of holding the board meeting. Okay? Where the predominant activity is taking place. So if day-to-day activities of mine are taking place from here, major decisions are taking place from India, and in Singapore I'm just holding a board meeting just for the sake of holding it, it is not the place where the poem is. The place for poem will be in India. Or if, the board is there, the board of director is just there as, like formally having some body. But they are not taking the decision. It is somebody else, like some senior management is there. Some shareholder is there. Some legal or financial advisor is there. Who is taking the decision? And the board just accepts those decisions, just ratifies those decisions. Then the poem will be the place where the senior managers or these legal advisors take the decision. So whosoever is formulating the key strategies and policies for the company and ensuring those are executed, that can be a managing director, can be CEO, CFO, financial director, COO, can be anybody. Can be some committee if the powers are delegated to that committee. Okay. So you need to ask those questions. You need to also see where is the head office of the company, which can show that, okay, these are the major decisions are being taken over there. So if there is a head office located in, let's say, Singapore, where most of the senior management is sitting, which is the principal place of their business also, then that can be also an indicator that that is where the poem is. However, if the business is more decentralized, where people are operating from different jurisdictions, then you need to see that where are the senior management sitting, where are they based, where are they usually taking the decisions for the company. Okay, so that is where the poem lies. Or these days the decisions may also be taken up from home. So you need to see where the directors are taking these decisions. So usually it is the board of directors that take the decision. But if the shareholders are somebody who is taking the decision and the board of directors are just ratifying it, then it is the place where the shareholders are taking the decisions. Because generally the shareholder decisions are very minimal, which are usually pertaining to dissolution, liquidation, where you need to obtain the approval from the shareholder because the existence of the company itself is in question and that affects the right of the shareholder. However, if the shareholders are taking the key decisions and not the board, then that is the place where the poem is. Now, just because the fact that the foreign company is completely owned by an Indian company, or there is a permanent establishment of a foreign company here in India, or there are some of the directors based in India, some local management is there in India, that doesn't lead to a fact that there is a poem in India. You don't automatically come to a conclusion that there is a poem in India. The poem is dependent on seeing who are the directors who are making those key decisions. Just because we have one director here, that doesn't imply that there is a poem here. Or if the Indian parent company is here, that doesn't imply that there is a poem here. Whether that Indian company is taking the decisions for the foreign company, and that should be the key decisions. So that is what you need to see. Are we clear? Let's look at few examples from the module. Company A is a sourcing entity for a multinational group incorporated in country X and is 100% subsidiary of the BCO. The warehouses and stock in them are the only assets of the company and are located in country X. All the employees of the company are also in country X. The average income-wise breakup of the company's total income for the 3 years is 30% of the income is from transaction where purchases are made from parties which are non-resident and sold to associated, non-associated to associated. 30% is from the purchase from the AE and sold to AE. 30% of the income is from transactions where purchases are made from AE and sold to non-AE. And 10% of the income is by way of interest. So in this case, how do you determine the ABOI test? Yes, Jay, very good. So here we look at only these 30% of the income where the transactions are from AE and sold to AE and the interest income. So 40% is my passive income. So the first test is satisfied. My passive income is less than 50% of total income. They do not have any assets in India. They do not have any employees in India. So other three conditions are also satisfied. So therefore the ABOI test gets satisfied. Next example is the other facts remain the same with the variation that ECO has total of 50 employees. 47 employees managing the warehouse, storekeeping and accounts are located in country X. MD, CEO and sales are resident in India. The total annual payroll expenditure on these 50 employees is of 5 crores. The annual payroll expenditure of the MD, CEO and sales head is rupees 3 crores. Yes. 60% of employee cost. Yes, Samnithan, very good. So, if you look at all the other tests are satisfied. Now, less than 50% of employees are situated in India. However, the payroll expenditure in respect of those employees which are situated in India is more than 50% of total payroll expenditure. So, if all the four conditions are not satisfied, the ABOI test fails. Now, third is the basic facts are same as in example 1. All the directors are Indian resident. During the relevant previous year, 5 meetings of the board are held, of which 2 are held in India and 3 are held outside India with 2 in country X and 1 in country Y. Yes. So the active business outside India test is satisfied as all the conditions are satisfied. And the majority of the board meetings are held outside India, and therefore, in that case, the poem is outside. Next is the facts are same as in example 3. But it is established by the AO that although ACO's senior management team signs all the contract for all the contracts about 10 lakh, the ACO must submit its recommendation to BCO and BCO makes a decision whether or not the contract may be accepted. It is also seen that during the previous year, more than 99% of the contracts are about 10 lakh, and over the past year, the same trend has been in respect of the value of contribution of contract over rupees 10 lakh is seen. Yes. So here ACO's power have been usurped by the BCO. So therefore the poem may not be presumed to be outside India even if all the conditions are satisfied. Right? Because ACO is taking the approval of the BCO every time. Are we clear? An Indian multinational group has holding local holding company ACO in country X. The ACO also has 100% downstream subsidiary BCO and CCO in country X and DCO in country Y. The ACO has income only by way of dividend and interest from investment made in its subsidiary. The place of effective management of ACO is in India and is exercised by ultimate parent company of the group. The subsidiary B, C, D are engaged in active business outside India. The board meetings of the board of directors are held in country X and country Y for B, C, and D. Yes, Samnithan, very good. Yes. Yes, what about others? What do others think? Yes. So you need to see for all the entities separately. Just because for B, C, and D, the ACO holding company is a resident of India doesn't mean that B, C, D also have the poem in India. You have to assess independently for each of these companies. Okay. Next is ABC Inc., a Swedish company headquartered at Stockholm, not having a PE in India, has set up a liaison office in April in 2024 in compliance with the RBI guidelines to look after its day-to-day business operation in India, spread awareness about the company's product, and explore further opportunities. The liaison office takes decisions relating to day-to-day routine operation and performs support functions that are preparatory or auxiliary in nature. The significant management and commercial decisions, however, are in substance made by the board of directors at Sweden, determining the residential status of ABC Inc. for 25-26. Yes, Jay. So here, just because they have a liaison office in India, liaison office means what? Which, is just acting as a communication channel between the holding company and the customers here in India. So it is just a support office. So just because they have a liaison office here in India, that doesn't mean they have a poem in India. If the significant management and commercial decisions are taking place in Sweden and only day-to-day routine operations or support functions are taken by the liaison office, then in that particular case, the place of effective management will be outside India. Yes, Suchita. Okay. Now, once a company has a poem in India, it becomes a resident in India. So in that particular case, it will have to comply with the Indian regulations. Yes or no? So how do you determine, first of all, for the depreciation, the WDV? Because now you will be assessed on your total income, which is a global income, right? Because now you are a resident of India. So obviously we'll allow you the depreciation. Now till now, you have been assessed to tax in the other country, or you may not have been assessed to tax also. But I will allow you the depreciation on your assets. So for that purpose, section 115JH provides for the transitional mechanism. And in that connection, the notification of 2018 notifies the provision as a transitional mechanism. So how do you determine the WDV? So if the foreign company is assessed to tax in the foreign jurisdiction, then the WDV will be as per the tax records, as on the first day of the previous year. And if WDV is not available as per tax records, then the WDV shall be calculated assuming the asset was utilized or used and the depreciation was actually allowed as per the law of that country. And the WDV will be arrived as on the first day of the previous year. If the foreign company is not assessed to tax, then you take the WDV as per the books of accounts. Now, you will also have to maintain the balance sheet and P&L over here. So, foreign company is required to prepare its balance sheet and P&L from the period starting from the date on which the accounting year begins there up to the 31st March of India, because there the accounting year can differ from our accounting year. We follow April to March. They may follow calendar year. Now, the period which begins there, right, is less than 12 months. So let's say, for example, if they follow a calendar year period. So now you have to prepare the balance sheet and P&L from the 1st January to 31st March over here. And next will be from 1st April to another 31st March. So if the period is greater than 6 months, and if the period is less than 6 months, then how do you do? So you will first prepare, let's say, for example, if we look at this year, if this year the company becomes a resident of India, I have to prepare, and they follow the calendar year over there. So I will have to prepare from 1st January to 31st March. That is one period. And 1st April 24 to 31st March 25, that's the second period. Now the first period is less than 6 months. Then I will have to prepare for the 1st January to 31st March 25 as a one period. But if the period is greater than 6 months, let's say they follow July to June. So then I have to prepare from July 23 to March 24 and April 24 to March 25. Now this period is greater than 6 months, the first period. So I have to prepare the two separate balance sheet and P&L. Are we clear? Now, what about the brought forward business losses? Now, since your total income now is being assessed, your global income is now being assessed to tax in India, we will also allow you your losses over there and the unabsorbed depreciation. So, if the foreign company is assessed to tax in that country, we will take the brought forward losses and UAD as per the tax records. If it is not assessed to tax, we will take it as per the books of account. However, you have to understand that the brought forward losses which will be allowed for the remaining period. Remaining period as in, you will not be allowed for fresh 8 years. the period will be calculated from the year in which it occurred up till now. So whatever remaining period is there, only for that period the brought forward losses will be allowed. Secondly, the set off of the losses, the brought forward loss and the UAD of that particular country will be only allowed to be set off against the income which is now chargeable to tax in India on account of the company becoming a resident of India. So it will not be chargeable, it will not be set off against the Indian sourced income. So which means what? Let's say, for example, if the income from the branch in India is 2 crores. Now this income would have been taxable in India irrespective of the fact that the company is a resident of India or not, because this income is accruing or arising in India. Now let's say this company becomes a resident in India because it has a poem in India. And the global income of this company is, let's say, 5 crore. And the brought forward losses are 6 crore. So now we will not set off the entire 6 crore. We will only set off against the 5 crore rupees. Are we clear? Is this understood, students? Yes or no? Okay. Now what will be the tax rate for this foreign company having the poem in India? As you mentioned earlier, it will be 35% and not 22 or 15 or 25 or 30%. It will be 35%. What will be the surcharge? What will be the surcharge for this company? 12%? No. The surcharge will not be 12%, students. What will be the surcharge? Sorry, I think my screen just got closed. Yes, what will be the surcharge? No, it's not 12%. What is the surcharge for the foreign company? Yes, Jay, very good. 2% and 5%. So if the income is up to 1 crore, sorry, it is up to 10 crore, it is 2%. Otherwise, it will be 5%. Are we clear? It is not 12%. Please do not make that mistake in the examination. Are we clear? Okay. And the TDS, let's say for example, if any company pays to this company, which has become resident of India, the TDS will be deducted under 194 J, I, all those sections, or under 195. It will be deducted under 195, not 194 J, not 194 C, because that is a more specific provision. Okay. So that is about the residential status. Now there is one more circular which is applicable for a non-resident individual. If a non-resident seafarer receives the remuneration in a bank account in India. So a non-resident seafarer who is, into the crew member who receives the services for his services rendered outside India, some salary. But that salary, for the convenience purpose, he does not, get outside India because he maintains a bank account in India. So in that connection, the CBDT has clarified just because the income is received in India in the bank account, that will not be considered as Indian received income. So ideally, he should, have received it outside India because he is providing the services outside India. But, for convenience purposes that, he has gone for a short while, so he doesn't want to open a bank account here. He wants to get the salary in his Indian bank account. Now, as per Section 5, it says for a non-resident, any income received in India is taxable in India. So this causes hardship for them. So the CBDT has clarified that for a non-resident seafarer for services rendered outside India on a foreign going ship, the total income will not include the salary which has been credited to the Indian bank account. Are we clear? Okay. Let us solve a question from the module now. Let us solve few questions from the module. Piyush, who returned to India on 12th June 2024 for permanently residing in India after a stay of about 20 years in UK, provides the sources of his various income and seeks your opinion to know about his liability to income tax, assuming that he has exercised the option to shift out of the default tax regime. Income of rent of the flat in London, which was deposited in a bank there. The flat was given on rent by him after his return to India since July 2024. So first of all, what will be his residential status? Resident but not ordinary resident, yes Namnathan, yes Jay. So he has returned to India on 12th June. So he stays in India for 293 days, which is more than 182 days. Right, here we'll consider 182-day period. However, he would be RNOR because he has been always outside India. So we are assuming that he has been outside India for 9 out of 10 years. And his stay in India is less than 730 days because he has never been to India. Now what will be if he's an RNOR income of the rent of flat in London? What will happen to that? Not taxable in India? Yes, very good. So this is the income which is accruing or arising outside India, which is also received outside India. So therefore, this will not be taxable in India. Yes, Suchita. Next, about the dividends. So what are they saying is dividend on shares of 3 German company which are being collected in a bank account in London. He proposes to keep the dividend in London with the permission of the RBI. Again, not taxable in India. Very good. Because this is the accrual outside India, received outside India. Third is he has got 2 sons, one of whom is 12 years and other 19 years. Both his sons are staying in London and not returning to India with him. Each of his son is having income of 75,000 in UK in foreign currency, which is not received in India, and of rupees 20,000 in India. Yes. Income of 20,000 would be clubbed after deduction. Yes, Jay. Yes, Ruchita. Very good. So the income of rupees 20,000 which is there, this will get clubbed because he is a minor son after providing a deduction of rupees 1,500. The rest income is not accruing or arising in India and therefore will not be taxable in India. Then, during the preceding accounting year, when he was a non-resident, he had sold 1,000 shares which were acquired by him in British pound sterling and the sales proceeds were repatriated. The profit in terms of British pound sterling on sale of these 1,000 shares were 175% of the cost, while in terms of Indian rupee, it was rupees 50,000. Not taxable. Why, Ruchita? Why not taxable? Because yes, this is of income previous year and this is just repatriated. This is not the Indian income. This is just repatriated. Are we clear? Okay. Any questions? Any doubt till now? If repatriated, then taxable? No. Even if it is repatriated, repatriation is not taxable. Repatriation is not received. Repatriation is just sending back the income. So that will not be taxable, Samyathan. Okay. Now coming to the next concept of accrual year in India. For a non-resident, the income will be deemed to accrue or arise in India, or for a RNOR, if the income is deemed to accrue or arise in India, then in that particular case, it is taxable in India. It falls within the scope of the total income, right? Now, what do we mean by the income which is accruing or arising? What do we mean by accruing? Accruing means the right to receive the income. It is different from the concept of due. Due is, let's say for example, if you are working for the entire month, your salary will become due on 1st of next month, right? When you get the right to receive the salary from the employer. But it accrues every day when you are working, right? So accrue means that when you have the right to receive the income. That is the accruing or arising. What is deemed to accrue or arise? Even if it doesn't accrue or arise, it will be deemed to be accruing or arising in this situation. So section 911 says income accruing or arising whether directly or indirectly through or from any business connection in India. Right? What do we mean by business connection in India? Business connection includes business activity carried out by a dependent agent who is acting on behalf of the non-resident. Who is a dependent agent? Who has and habitually exercises the authority to conclude the contracts on behalf of non-resident. Let's say if he is, concluding the contracts, he is negotiating the contracts and entering into the contracts with the customer for the non-resident. Or even if he is not concluding the contract, he plays the principal role leading to the conclusion of contracts by non-residents. So even if he doesn't conclude, he doesn't enter into a contract with the customer, but he does all the other terms, decides the pricing, enters into negotiation, finalize the deal, the conclusion may only be done by the non-resident principal. That is a dependent agent. Because if, I am not doing the business myself, but I am doing it through some other person who is only working for me, who is helping me to enter into the sales in India, then it is as good as I'm doing it myself. Right? You have done under the contract law, he who works through the agent does it through himself. Or, agent binds the principal. That's the same thing over here. And so if I'm not doing the sales directly, I'm doing it to some other person, all the sales will be attributed to me, and that will be called as the business connection in India. Business connection otherwise is not defined. It includes any sort of business activity where you are having a regular engagement in India, where you are having an organized activity carried out in India. Okay, that is the business connection. Or habitually maintains the stock of goods from which this agent delivers on behalf of non-resident. Or he habitually secures the orders mainly or wholly for that non-resident. Or even if not for the non-resident, but for any other non-resident who is the related party to that non-resident for whom he has been working for. Are we clear? So, in these cases, the business connection gets concluded or is established. However, if an agent is operating in an independent capacity, like he is not controlled by a non-resident, he's working for multiple principal, not just for one non-resident principal. He's acting in the ordinary course of business. He exercises his own judgment and not works under the direction of one non-resident. Then he will not be considered as a dependent agent and he will not constitute the business connection for non-resident. A person is not an independent agent if he is mainly or wholly working for one non-resident or for the related non-residents which are there. A business connection is also constituted if you have a significant economic presence. What do we mean by significant economic presence? That you are not operating by having any presence in India. You are not having any business activities carried out in India. You are not having any organized activity carried out in India. So you may not have business connection. However, you are doing the transaction in respect of goods, services, or property with any person in India. Now, this transaction can be advertising, marketing, transportation, can be any transaction in respect of any goods, services, or property, including the download of data or software in India, where the aggregate value of these transactions is exceeding rupees 2 crores. Or you have been engaging with the users in India, more than 3 lakh users, then you constitute the significant economic presence. Okay? Now, in all these cases, whether you have a business connection or significant economic presence here in India, only the income which is attributable to that transaction shall be deemed to accrue or arise in India. Not all the income. Let's say if my sales value is 100 rupees, my profit is 50 rupees. Not entire profit will be taxable in India. Only the portion of that rupees 50, the portion of that profit which is earned in India because of the activities carried out in India will be deemed to accrue or arise in India. So let's say if I'm only doing a marketing activity over here, so out of 50 rupees, I will only attribute percentage of that 50 which shall be attributable in India. Are we clear? Now this income which is attributable to operations carried out in India will include the income from advertisement, targeting the customers in India, sale of data collected from Indian person, or sale of goods or services using the data collected from Indian person. Okay. Now, what shall not constitute the business connection? What shall not constitute the business connection? So, there are certain exceptions. Purchase of goods in India for the purposes of export outside India. Collection of news in India for transmission of outside India. Shooting of cinematograph films in India. Or activities confined to display of rough diamonds. Okay. So, that is about the business connection. Next is income accruing or arising through or from a property in India. Let's say I earn a rental income from a property in India. or I earn some income from the shares, I earn some income from the deposits in an Indian company. That is the income from a property, asset or source of income in India. Income through the transfer of capital assets situated in India. So let's say, for example, if I transfer the share, if I transfer a residential house property, even if the registration of property takes place outside India, the buyer is outside India, the sale consideration is paid outside India, but since the property is situated in India, the capital asset is situated in India, the income through the transfer of capital assets shall be deemed to accrue or arise in India. Now, a capital asset situated in India shall include shares of a foreign company if it derives the value directly or indirectly substantially from the assets located in India. So if the foreign company is there, let's say this company B which is there, now if the company B has the only investment in company C which is a resident of India, yes Jay, Vodafone case. So in that particular case, the shares of company B are deriving the value from the asset in India because the only asset in the balance sheet of company B, which is a foreign company, is the shares of Indian company. So obviously the share capital, the liability side, you will derive the value from the asset side itself. Now as the value of the company C will grow, the shares of company B will also grow. So what they are saying that the shares of company B shall be deemed to be situated in India if the shares derive the value from the Indian asset or the Indian shares. Now, how do we say that the value of the Indian shares, the shares of company B are deriving the value from the Indian shares? So you need to first identify the specified date for determining on which the value has to be taken. So for identifying the specified date, on what date I have to take the value? To identify whether the shares of company B derive the value from the Indian company shares, you need to identify on which date I will take the valuation. So that is a specified date. So specified date for determining on which the FMV has to be taken is decided on the basis of whether the book value of assets of foreign company as on the date of transfer of its shares is greater than the book value of assets of the foreign company on the accounting year end, total book value. If it is yes, then the specified date will be date of transfer. If it is no, then you will take the date of the accounting year end. So you need to first ask the question on which date I shall determine the value. That is my specified date, whether it is date of transfer or whether it is the accounting year end. So for that, you need to perform a test, whether the book value of the assets of foreign company is greater by 15% of the book value of assets of the foreign company as on the year end. If yes, the specified date is date of transfer. If no, it is the accounting year end. Now, once you have found the specified date, now you need to see if the shares of the company B derive the value substantially from the Indian company's shares. So for that, you need to see the FMV of the Indian assets as on the specified date is greater than rupees 10 crore plus the FMV of Indian assets as on the specified date is more than 50% of the FMV of the total assets of the foreign company. If the answer is yes, then yes, the shares derive the value substantially from the Indian. And then in that case, the shares of the company B shall be deemed to be situated in India. Means when you sell the shares of company B, the capital gain on those shares will be deemed to accrue or arise in India. The exceptions to this are in case of the foreign portfolio investors, in case the transferor has less than 5% of shareholding in foreign company or a transferor is not holding the right of management or control, in those cases, this rule is not applicable. So it is not going to affect the small shareholders. Further, if the dividend is declared by this Mauritius company, now because the shares of the Mauritius company are deemed to be situated in India, the dividend on these shares will not be deemed to accrue or arise in India because this has been clarified by the CBDT circular. Ruchita, in case of greater than 50% of the total asset, we need to consider the total asset of Indian and foreign company both. No, you need to see the FMV of the Indian asset, which is, let's say, investment in company C. What is the FMV of this? And the FMV of the total assets of the company B. So you need to take the FMV of the total assets of company B itself, not the Indian company. Are we clear? Okay. Yes, students, any question, any doubt? Okay, so this is section 911. Then we have section 912, which says that if a foreign company or an Indian company pays the salary to a non-resident employee. Now the salary shall be deemed to accrue or arise in India if the non-resident employee renders the services in India. If then the salary is earned in India. How is the salary earned in India? If the services are rendered in India. So if a foreign company pays to a non-resident employee for the services rendered in India, the salary shall be deemed to accrue or arise in India. And under which section you will deduct the TDS? In which section foreign company is required to deduct the TDS? (192). Not under 195, under 192. J under 192. Okay. Then in respect of the government, where the employer is the government, where the salaries are paid by the government to a citizen of India, even for the services rendered outside India, it shall be deemed to accrue or arise in India. However, any allowances or perquisites to a citizen of India by the government for services rendered outside India are exempt under 10(7). And this is available irrespective of the regime under which you pay the tax. Okay. Next is remuneration to a person who is not a citizen of India by a foreign embassy. Again, that is exempt. Or remuneration to a foreign national by a foreign company for services rendered in India is exempt if the foreign company is not engaged in any trade or business in India, if the stay of the employee is less than 90 days, and the remuneration is not allowed as expense from the income of the employer chargeable to tax in India. Okay. Then we have 914, dividend paid by an Indian company. Even if it is paid outside India, it shall be deemed to accrue or arise in India. What is the tax rate for the dividend? Yes, dividend is chargeable to tax under section 115A. Dividend is chargeable to tax under 115A at the rate of 20%. Dividend is going to be taxed under 115A. Okay, so 115A is a specific section which provides for the tax rate on the dividend. If it is a dividend received from a unit in IFSC, then it is 10%. Other dividend, it is 20%. Next is, if the dividend is paid by a business trust, where SPV is exercising the option under 115BAA, it is 10%. If the SPV is not exercising, then it is exempt. Okay. Next is section 914, 915, 916, interest, royalties and FTS. Now the source rule for that remains the same. What is it? The interest shall be deemed to accrue or arise in India. The interest shall be deemed to accrue or arise in India if it is payable by the government of India or by a resident of India, except if the interest is payable in respect of any loan taken or money borrowed for carrying out the business outside India or for making or earning any income from a source outside India. So let's say, for example, if a non-resident has taken a loan from the Indian bank. Okay. Now this loan has been taken from, sorry, if a resident has taken a loan from a non-resident bank, let's say an Indian company has taken a loan from Citibank USA. Now Indian company will pay the interest. So income shall be deemed to accrue or arise in India. However, if Indian company has borrowed this money for starting a new business in USA, then in that particular case, the interest shall not be deemed to accrue or arise in India. Are we clear? Then in that particular case, interest shall not be deemed to accrue or arise in India. Are we clear? And if a person is a non-resident, if let's say for example, foreign company has taken a loan from Citibank USA and it is paying the interest for carrying out the business in India. If the loan is taken for carrying out the business or profession in India, then in that particular case, interest shall be deemed to accrue or arise in India. Okay. Now, interest paid by a branch of a bank to its head office on the loan taken from head office shall not be deemed to accrue or deemed to accrue or arise in India. Plus, it will also be taxable in the hands of that foreign company. So, for this purpose, a branch will be deemed to be a separate and independent from the head office. They will not be considered as a part of same unit, even though branch is not a person. But for the purposes of this interest income, it will be considered as a separate entity, independent from the enterprise, independent from the head office. Similarly, in the case of royalty, royalty shall be deemed to accrue or arise in India on the same basis. Okay. And same goes with the fees for technical services. So royalty also will be deemed to accrue or arise in India when it is payable by the government of India, when it is paid by a resident in India, except where it is, taken for the business outside India or for a not paid by a non-resident for the business in India. Now, what is the definition of the royalty? So royalty, let us look at the definition of the royalty from the module itself. Royalty means consideration for the transfer of all or any rights, including the granting of a license in respect of a patent, invention, model, design, secret formula or process. So where you transfer the right to use any patent, to use any invention, the consideration is royalty, unless you transfer the entire right itself, under which case it will be under capital gain and not royalty. Where you are imparting the information as to how should we use a particular model or how should we use a process, that is royalty. Where you are allowing the usage of that patent. You're not just allowing them the right, but you're giving them the usage of that design, to use that and incorporate into your own design, or to use some process or to use some formula and incorporate into your medicine, to use some computer code and incorporate into your code. That is the use. That is also royalty. Or any technical, industrial, commercial or scientific knowledge has been imparted, or using any industrial, commercial or scientific equipment, or transferring of any rights in respect of copyright, literary, artistic or scientific work, or rendering of any service in connection with the above. That all that constitutes the royalty. Now, consideration for the use or right to use a computer software is also royalty. So when you allow the usage of the computer software, it can be any software, whether or not you get the right to modify the code of it, irrespective of how you transfer that right, this will constitute the royalty. However, if you remember under the TDS provision, there is a provision which says that under 194J that if the software is acquired and the TDS has already been paid on it, and then you are just reselling the software, then the reseller need not deduct the TDS if it has been already deducted at first tranche. So in a subsequent transfer, the TDS should not be deducted if there is no modification to the software. Now the question arises where there is no right of modification, where I just take the Tally license, where I take the SAP license, where I do not modify any code, or where I download the apps and use those apps, where there is an end user license agreement, where the only end user is buying the software. Or even in case a distributor is buying, but he's selling without any modification. Is it a royalty? Under the Act, it is yes. But the Supreme Court in Engineering Analysis Center of Excellence case has held that under the tax treaty, where the right to modification of software is not given, it will not be considered as royalty. Under the Act, it is a royalty because the definition under the Act specifically says right to use a computer software is royalty. But under the tax treaty, this will not be royalty. Okay? Then consideration in respect of right, property or information will include any right, property or information irrespective of whether it has been transferred to the user or the payer, whether or not it is used by the payer, whether or not the property is located in India, doesn't matter. Okay, and the process should also include the process of satellite, process of internet technology, all of that will get included in the process. Finally, what is the fees for technical service? Fees for technical services means any consideration for the rendering of any managerial, technical or consultancy services. It does not include the consideration for construction, assembly, mining. So now what is managerial? Managerial means that, if you are paying somebody any consideration for managing the things, technical is technical and consultancy is when you are providing some sort of consultancy services. Now the term technical is not very wide understood. So whether it includes the automated services, the Supreme Court has said that no, it doesn't include automated services. The term technical derive its meaning from the neighboring word managerial or consultancy. Managerial or consultancy requires some human intervention. So purely automated services are not technical services. It has to be some customized service. It cannot be some generic sort of services. Are we clear? And then finally, the deemed to accrue also includes the payment of any money, any sum of money paid by a resident to a non-resident or a foreign company or to RNOR shall be deemed to accrue or arise in India if the value is more than 50,000. Okay? So this is only in respect of money, not in respect of property. Are we clear? Yes or no? Now, what is the tax rate in respect of interest? Interest, what is the tax rate? So, in respect of interest received from the government or an Indian concern, it is 20%. Again, under 115A. Interest from an infrastructure debt fund, it is 5%. Interest received from an Indian company or a business trust in respect of money borrowed from a source outside India by way of a long-term bond or rupee-denominated bond, which is listed on a recognized stock exchange in IFSC, it is 9%. And interest which is distributed by the SPV, it's distributed by business trust, which is received from SPV, is taxable at 5%. What is the tax rate for royalties and FTS? It is 20%. or the rate under the DTL. Okay. So these are the special rates of tax. These are on the gross basis, meaning no expenditure is allowed against such incomes. The deduction under Chapter 6A is not available in respect of dividend and interest. In respect of interest and dividend, the Chapter 6A deduction cannot be claimed. However, if it's an IFSC unit, it can claim the ATL. And the assessees in respect of these income who are offering the incomes to these tax shall also not be required to prepare a return of income if the income only consists of dividend, interest, royalty or FTS and the TDS has been paid at such rates. Are we clear? Now, in respect of royalty and FTS, there is one more section which is applicable. What is that section? 44DA. What is section 44DA? Section 44DA is a special provision for royalties and FTS. So what does it say? Section 44DA says that if the royalties and FTS are effectively connected with the P that a non-resident has in India, then instead of 20% on gross basis, you can calculate the income on the net basis and pay the tax at 35%, which is applicable to a foreign company. Are we getting it? So in case of royalty or FTS, either you have an option to pay the tax on 20% on gross basis if you do not have a P. And if non-resident has a P, you can pay it on net basis, that is income minus expenditure wholly and exclusively incurred for the P. What is the expenses wholly and exclusively incurred for the P? So, any expenses which are necessary for the P. Any kind of HO expenses other than the reimbursement of actual expense, any expenses paid to HO are not considered wholly and exclusively. So if you now maintain the books of accounts, get them audited, you can pay it on net basis and the tax rate will be 35%. What will be the due date of filing of return on income in these cases where you have to get the books of accounts audited? 31st October. And tax audit, if it is applicable, 30th September. If it is a transfer pricing case, it will be 30th November and the due date of audit will be 31st October. Are we clear? Yes or no? Loan taken for investment in shares. Can we deduct 20% of dividend or actual interest, whichever is lower as deduction? Loan taken for investment in shares. Yes, you can deduct 20% of dividend or actual interest, whichever is lower. Yes, Jay, you can. Okay, students. Any questions, any doubt? Before we take a break. Okay, let us take a break over here. Let's take a break. So students, now we'll look at the presumptive tax provision for the non-resident. So these particular provisions just operate like your 44 AD, ADA. These are some specific provision for the non-resident in terms of the presumptive sections. Okay. So number one, we have section 44 B, which is in terms of the special provision for computing the income of the shipping business. Of course, other than the cruise shipping. So here you need to take into consideration the 7.5% of the amount paid or payable, whether in India or out of India, to the assessee in respect of the carriage of passengers, livestock, goods shipped at any port in India, plus 7.5% of the amount received in India on account of the carriage at any port outside India. And these amounts will include the demurrage and handling charges. What are demurrage charges? Demurrage charges are basically the charges which are levied if you do not take out the goods from ship. So if you keep the goods in the ship itself, they will levy you these demurrage charges. So these amounts will get included. Now for a shipping business, they have an option to go for this presumptive rate of 7.5%, or there is also section 172 which is applicable. What is section 172? Yes, what is section 172? Yes, sure. What is section 172? Yes, students. One 172 is a complete code in itself, isn't it? 172 tells you that the income of the previous year shall be charged or assessed to tax in the same year. So if where a ship is leaving the India, before that it has to pay all its taxes. Only then it will get the clearance or clearance certificate, right? So 172 says that how do we compute the income of the shipping company? It will be 7.5% of the amount paid or payable in respect of the carriage, right? In respect of any carriage that is there shall be deemed to be the income accruing or arising in India, which are shipped to at any port in India. Okay, so that shall be deemed to income accrue or arise in India. And the tax rate in this case shall be that applicable to a foreign company. Even if the shipping company, shipping entity is a partnership firm, it is LLP, or it is, not LLP, of course, a foreign company, it's a partnership firm, or it is AOP, BOI, or it is carried out in individual name, whatever it is, the tax rate will be that of the foreign company. Now, before this ship leaves, the assessee has to pay the taxes, file the return of income by paying all those taxes, and only then it will get a clearance certificate once the AO determines that there is no tax liability due. And only then the ship can leave India. Or however, the ship owner has the option to file the return as per the normal provision and claim this 172 tax paid as an advance tax in the assessment year. Are we clear? So this is the provision which is there for the shipping company. So it can go in the next year as per 44B and then claim the 172 tax paid as an advance tax, or it can pay just under 172 itself. Is there any question, any doubt? Yes? Is this clear, students? Then next is 44 BBA, which is for the airline company. The airline companies have an option to exercise this presumptive rate, which is given under 44 BBA, which is flat 5% of the amount paid or payable in respect of carriage from any place in India or amount received or deemed to be received in India in respect of any carriage from any place outside India. Okay, so that is section 44 BBA. Then you have section 44 BB, which is for the exploration of mineral oils. So any businesses which are in the business of providing services in connection with the supplying plant and machinery on hire to be used for extraction or production of mineral oil, they can opt for presumptive rate of 10% in respect of the amount paid or payable on account of provision of services or facilities or supply of plant and machinery in India, and amount received or deemed to be received in respect of the services or facility or supply of plant and machinery to be used for production of the mineral oil outside India. So here you will not get any set off of the unabsorbed depreciation or brought forward business loss. However, you have an option to claim lower than 10% by maintaining the books of accounts and getting them audited. Next is presumptive rate for the non-resident engaged in the civil construction, so or turnkey power projects. So here you have an option to claim 10%. You have an option to claim lower than 10% if you get the books audited. Then in respect of the cruise ships, here the presumptive rate is 20% of the amount paid or payable on account of carriage of passengers or received or deemed to be received on account of the carriage of passengers. Okay, so these are the presumptive provisions which are applicable. Let us solve a example from the module so that we get clearer with respect to this. Mr. Q, a non-resident, operates an aircraft between Singapore and Chennai. He received the following amounts while carrying on the business of operation of aircrafts for the year ended 31st March 25. Rupees 2 crores in India on account of carriage of passengers from Chennai. Whether you will include this? Yes, right, we will include this. Then 1 crore in India on account of carriage of goods from Chennai. Yes, this also will be included. 3 crores in India on account of carriage of passengers from Singapore. This will also get included. 1 crore in Singapore on account of carriage of passengers from Chennai. Include, right? So the total expenditure incurred during the year was 6.75 crore. Whether this is relevant? No, right? So here on the basis of this, you will compute the the presumptive profits will be 5% of 7 crore, which is 35 lakh. This will be chargeable under the head PGBP. Are we clear? Yes or no? Okay. Next provision is section 44C, deduction of the head office expenditure. So when the branch makes the payment of any expenditure to the head office, there is a restriction on the amount of expenditure that can be allowed as deduction, which is restricted to the lower of the following: 5% of the adjusted total income, or in the case of loss, 5% of the average adjusted total income, or actual expenses incurred in India. Now, what is my adjusted total income? The adjusted total income here means the total income without considering the unabsorbed depreciation, brought forward losses under the business loss, speculation loss, capital loss, specified business loss, before any Chapter 6A deduction, any unabsorbed family planning expenses. So before that, whatever total income is there, that is my adjusted total income. Average adjusted total income means where the total income in case of the loss will be assessable for 3 assessment years, the average of that. Where income is available for 2 years, then only 2 years. Okay, so that is my average adjusted total income. Or head office expenses incurred in India. Head office expenses means any executive or general admin expenses which are in respect of rent, rates, taxes, repairs, insurance for any premises used outside India for the business, salaries, pension, bonus, commission, gratuities for any employees which are managing the office outside India, for any travel related expense of any employees outside India, or any other executive expenses, right? So lower of this will be allowed as the deduction. So let us look at again the question from the module in this regard. The net result of the business carried on by a branch of a foreign company for the year ended 31st March 2025 was a loss of 100 lakhs. After the charge of HO expenses of 200 lakhs allocated to the branch, explain with the reasons the income to be declared by the branch in its return for AY 25-26. Very simple question. Hundred lakh, yes. What will be the deduction? Yes, that's right. So in this particular case, first you will add back the allowance of the HO expenses that has been there. So my income will be 100 lakh. Now 5% of 100 lakh or 200 lakh, whichever is less. So 5 lakh will be allowed as the deduction. Are we clear? Okay. Next is now capital gain provision in respect of the non-resident. So for a non-resident, you have a specific provision which is first proviso to section 48, which is basically in respect of a non-resident who are using the foreign exchange to acquire the capital asset, being the shares of the Indian company or debentures of the Indian company. Then they get the benefit of the exchange rate fluctuation while computing the capital gain from the transfer of these shares or debentures. So how do you calculate this? First of all, this is only applicable to a non-resident and the eligible capital asset is share or debentures of the Indian company. Now be clear with this that this particular benefit is not available when you pay the tax as per section 112A. Okay. So in case of the listed shares where STT is paid on the sale and purchase both, in that particular situation, 112A, when you pay the tax rate, first proviso to 48 benefit you cannot take. Right? You cannot take it in that particular situation. So when you can take is when you have a listed share where STT is not paid on purchase or sale. And it is also not covered in the central government notification which exempts the STT on certain transactions. So in that case only you can claim the first proviso to 48. You can't claim it even on unlisted shares because on unlisted shares 112 specifically says first proviso to 48 is not available. And you can claim it on the shares purchased by a non-resident Indian. We will see that in the next point itself. How do you calculate this exchange rate benefit? So you convert all the amounts into the foreign currency based on the TTBR and TTSR average. For example, full value of consideration as per the exchange rate as on the date of transfer, cost of acquisition as on the date of purchase, expenses on transfer again as on the date of transfer, and basis that first you will calculate the capital gain in the foreign currency. And then you will reconvert the capital gain into INR using the telegraphic transfer buying rate as on the date of transfer. And the first proviso to section 48 is also applicable on the reinvestment made from the shares which have been sold. So let's say if I have purchased the ICICI Bank shares and now I am selling that and putting that amount in, let's say, the shares of Reliance. So the first proviso to 48 is not only available on ICICI Bank, it will also be available in respect of the Reliance share also. So on every reinvestment made in the shares or debentures of Indian company, it will be available. Are we clear? Okay. Whether this is available on short-term capital gains, the answer is yes. It is also applicable on the short-term capital gains. Yes or no? So it is not only restricted to long-term capital gain, this is also applicable on the short-term capital gain. Are we clear? Okay. Now, let us look at what are the tax rates for on the capital gain in respect of non-resident. So, where the transfer takes place before 23rd July in respect of unlisted shares or unlisted securities, the tax rate is 10% without the benefit of indexation and foreign exchange fluctuation benefit. Where the transfer takes place after 23rd July, it is 12.5% without the foreign currency fluctuation. So that's the reason why I said on unlisted shares, you can't claim first proviso. On listed securities other than the listed shares covered under 112A or zero coupon bond, it was earlier 10% without indexation or 20% with indexation, whichever is beneficial. After 23rd July, it is 12.5%. And here, in respect of the listed securities which are covered under 112, not 112A, you can claim the foreign exchange fluctuation benefit. Let us look at an example from the module. Mr. A non-resident Indian, remits US dollar 40,000 to India on 16th September 2006. The amount is partly utilized on 3rd October 2006 for purchasing 10,000 equity shares in A Limited, an Indian company, at the rate of rupees 12 per share. These shares were sold for rupees 48 per share on 30th March 2025. Fair market value of these shares on 31st January was rupees 35 per share. The TTBR rates are given. You have to compute the capital gain on the assumption that these shares have not been sold through recognized stock exchange, or these shares have been purchased and sold through a recognized stock exchange. Ignore the provisions of chapter 12A. We'll see that later. What is chapter 12? So how do we first calculate? First, where the shares are not sold through the recognized stock exchange. Now, what will be my sale consideration? $4.8 lakh. The shares are sold for 48 per share. How many shares are there? 10,000. So 48 lakh divided by what is the date of transfer? 30th March. on that day we have to take the average of TTBR and TTSR, which is 59 plus 61 divided by 2 comes to 60. Right? So for 4,80,000 divided by 60, 8,000 USD is my sale consideration. There are no expenses on transfer. What is the cost of acquisition? Yes, 10,000 into 20 is the cost of acquisition, no? 10,000 into 12 divided by, as on the date of purchase, which was on 3rd October, 19 plus 21, which is 20, the average of this, divide by 20. So this comes to 6,000. So 8,000 minus 6,000 is 2,000. Now again, I will convert this 2,000 using the what exchange rate? $59. Yes, TTBR as on the date of transfer. So this is how the exchange rate fluctuation benefit has to be considered, which gives me 1,18,000. Now where the shares are purchased and sold through a recognized stock exchange, then in that case, I will do as per the normal provision because I will not get the benefit of foreign currency fluctuation benefit. Are we getting it? So there I'll do 4,80,000 minus 1,20,000. And here, since the shares are purchased before 2018, I have to take the fair market value of 31st January 2018. So I will compare 35 into 10,000 shares, which is 3,50,000, lower of 3,50,000 and 4,80,000, which is 3,50,000, and then higher of 3,50,000, and the cost of acquisition 1,20,000 I will take. So 350 I will take because I will give the grandfathering benefit. And I will get the long-term capital gain 130. So only 5,000 will be taxable at the rate of 12.5% under 112A. Are we clear about this, students? Yes or no? Yes? Okay. Now the next provision is a special provision for a non-resident Indian, for NRI. There is a chapter 12A which is specifically applicable for NRI. What does it say? If a non-resident Indian, who is a non-resident Indian, an individual who is a citizen of India or a person of Indian origin. Who is a person of Indian origin? If his parents or grandparents are born in India. So if it's the individual who is a citizen of India or PIO, and he has made the investment in the foreign exchange, in the shares of Indian company or debentures issued by Indian company or deposits of the Indian company or any central government security, then he is entitled to this concessional tax rate of 20% on the investment income. And in case of LTCG, long-term capital gain, if the transfer takes place before 23rd July, then 10%. And if the transfer takes place after 23rd July, then 12.5% plus surcharge and cess. Here he will not get any Chapter 60 deduction, indexation before 23rd July, but he can claim the first proviso to Section 48. Plus, if the reinvestment is made in any asset within 6 months of the transfer, he can claim the exemption under 115F, which is just like your 54F. So if he reinvests within a period of 6 months of the transfer in the specified asset, here any asset will mean the specified asset itself, like Indian company shares, debentures, then the exemption will be capital gain into the cost of new asset divided by the net consideration. Okay. However, if the new asset is transferred within 3 years of its acquisition, then the capital gain of the original asset which is there, which was exempted under 115F, now shall be taxable as the long-term capital gain. Okay? So this is a specific provision only for the non-resident Indian. Again, let us look at the question from the module. Okay, one more thing. Here, the person who is an NRI, even when he becomes a resident, he can continue to be assessed under this chapter by giving a declaration until he sells the foreign currency assets. However, he has an option to opt out by this particular provision and to a normal provision. Okay. So let us look at the question from your module in this regard. Mr. John NRI purchased unlisted shares of an Indian company at a cost of 70,000 on 1st July 2010 in foreign currency. He sold the shares for 2,50,000 on 1st August 24 and the expenditure incurred wholly or exclusively in connection with transfer is 10,000. Compute the capital gain if we deposited in specified asset 1,50,000 out of the sale consideration. Ignore the effect of first proviso to section 48. So here they have specifically told you to ignore. Otherwise, you can consider if they have given you the exchange rate. So yes, how will you calculate? Yes, Jay, very good. So here my sale consideration will be what? 2,50,000 minus expenses on transfer 10,000. Net consideration is 240 less my cost of acquisition 70. So this gives me a long-term capital gain of 1,70,000. Now 1,70,000 into 1,50,000 divided by 2,40,000. You have to take the net consideration, not the gross sale consideration. That is 1,06,250. Yes, Ruchita. So my capital gain, long-term capital gain is 63,750. Let us look at another example. An NRI acquires the shares in Indian company A Limited on 1/1/2009 for 1 lakh in foreign currency. These shares are sold by him on 1st January 25 for 3 lakh. He invests 3 lakh in the shares on 31st March 2025 and these shares are sold by him on 30th June 2025 for 3 lakh 50. Discuss the tax implication. Ignore the effect of first proviso to 48. Yes, Jay, correct. So here my sale consideration is 3 lakh minus cost of acquisition 1 lakh. LTCG is 2 lakh. Exemption is I have invested entire 3 lakh. So 2 lakh will be exempt. Now I have sold these shares. So in the next year when I sell these shares, because I've sold within 6 months. So 2 lakh will be deemed capital gain. Yes. Yes, Lida, good. So, and over and above that, this 350 minus 3 lakh 50,000 will be also short-term capital gain. So LTCG of 2 lakh, which was exempt, become taxable in 26-27, and STCG of 50,000 is also taxable in that year. Okay. Now the next provision that we have is in respect of the income from the offshore bonds. Okay. So now what are these bonds which are there? So in case of the units purchased in foreign currency, in the case of offshore fund, offshore, so basically, what happens is that in case of the offshore funds, there are these funds established outside India. Now, in case of that, if there are any income received on the unit, or there is a long-term capital gain on the units of the mutual fund, then the tax rate shall be in respect of units 10%, and in case of long-term capital gain, it will be 10% before 23rd July, and after 23rd July, it will be 12.5%. No indexation available, no Chapter 6 deductions are allowed in that. Next is, and the short-term capital gain will be taxable at 15% if transfer takes place before 23rd July and 20% after that. Are we clear? Next is income from the bonds of GDR. Now, what are global depository receipts? So if any company wants to list on the US stock exchange or any foreign stock exchange, they cannot list directly. They have to list it through the GDRs. They have to issue the GDRs which derive the value from the shares of the Indian company. So where the total income of a non-resident includes the interest on the bonds of an Indian company or income by way of dividends on the GDRs or income by way of LTCG, then the tax rate shall be 10% in respect of that if it is prior to 23rd July. If it is after 23rd July, it will be 12.5% on the long-term capital gain. On dividend, it will be 10% on gross basis. If it is transferred to a resident and no Chapter 6A deduction, no indexation, no first proviso to 48, if it is transferred in IFSC, it is not regarded as a transfer itself. It is exempt. Period of holding prior to 23rd July was 36 months. After 23rd July, it is 24 months. If the GDRs are transferred by one non-resident to another non-resident, it is an exempt, whether it is long-term or whether it is short-term. The short-term capital gain will be chargeable at normal rates. And the TDS will be payable under 196C, 10%. And plus, if this is the only income, interest, dividend income, and the tax has been deducted, there is no requirement to file the ITR also. Same is also in the case of the Chapter 12 also. In case of this non-resident Indian, if the income is this income only and the TDS has been deducted duly, then they are not required to file the ITR. Next is the taxation of the foreign portfolio investor. Now, what are foreign portfolio investors? These are basically the investors who trade in the stock exchange. Right? These are portfolio investors, like big investors who invest in the stock exchange or the securities basically. So in case of the long-term capital gain, in respect of the securities which are covered under 112A, listed equity share, units of equity oriented fund which are listed units of business trust on which STT is paid. Before 23rd July, it was 10%. After 23rd July, it is 12.5%. Over and above, 1.25 lakh. In case of any other shares or other securities other than the 112A, LTCG 10%. Whether before 23rd July or after 23rd July. Short-term capital gain for the units for the shares covered under 111A listed equity share, listed equity oriented mutual fund or units of business trust before 23rd July 15%, after 23rd July 20%. Any other short-term capital gain 30%. Any income in respect of securities other than in respect of mutual fund, it is 20%. If it is mutual fund, it is 10%. Plus there will be surcharge applicable. However, what is the maximum surcharge? 15% if the income is in the nature of dividend, LTCG, STCG covered under 111A, 112A. Both under the new and the old regime. And if the FPI is an AOP, which has only company as members, again the maximum surcharge is 15%. There is a TDS applicable under 196D, which is 20%. Are we clear? Yes or no? And here indexation first proviso to 48 is not applicable at all. Plus they are not required to file any return of income if this is their only income and the tax has been duly deducted in respect of it. Okay? Any questions, any doubt? Fine? Yes or no, students? Little confusion about LCCG. In some cases, it is 12.5 applicable over and above 1.25, but in some cases, whole CG tax at 12.5. Yes, Ruchita. Those which are covered under 112A, which is listed equity shares on which STT has been paid both at the time of purchase and sale, or listed equity oriented mutual fund on which STT has been paid at the time of sale, or listed units of the business trust. In those cases, it will be 12.5% over and above 1.25 lakh. All other LTCG is only 12.5%. Are we clear? Okay. Okay. Let us solve a question from the module on the foreign institutional investors. Style Inc., a notified FII, derived the income for the financial year 24-25. Dividend from listed shares of Indian companies rupees 6,20,000. How will this be taxed? What is the tax rate on this? 20%. Very good. The tax rate is 20%. Okay? Yes, everyone? Fine. Then interest on securities 17,32,000. Expenses of 26,000 has been incurred to earn such income. Again 20% on 17.32 lakh. No deduction of the expenditure is allowed. Fine. Income from the sale of securities and shares. Bonds of J Limited. Date of purchase is 5th May 2018. Date of sale is 7th March 2025. Sale proceeds 47 lakh. Cost of purchase 32 lakh. The CII has been given to you. Yes, Jay, very good. Ruchita, why it will be? Yes, the capital gain is correct. What will be the tax rate? Tax rate on the bonds. So here, students, we will consider the tax rate of, it is other asset. Is it covered by 112A? No. This is not covered by 112A. Yes or no? This is not covered by 112A. So in this particular case, it is another asset. So that will be taxed at 10%. This will be taxed at 10%. What will be my capital gain? 47 lakh minus 32 lakh. Okay, 15 lakh. On that, the tax rate will be 10%. No indexation allowed because this is sale after 23rd March. 23rd July. So no indexation is allowed over here. Listed shares of E Limited, date of purchase 2nd May, date of sale 9th February, sale consideration 1240, purchase cost 780, STD paid both at the time of purchase and sale. Earlier one was long-term capital gain. This is a short-term capital gain. What is the period of holding? Less than 12 months. So my period of holding is less than 12 months. So therefore, in that particular case, what will be my tax rate? This will be 20% STCG. Yes. So sale consideration 12 lakh 40, cost of acquisition 780. On 4 lakh 60, I will charge 20% directly. Okay. Yes or no? Okay. Yes. Next is capital on this unlisted equity shares of M Limited. One second, I think my computer has hanged. Yeah. Unlisted equity share of M Limited, date of purchase 1st July, date of sale 7th March, sale consideration 840 and purchase cost 372. Again, it is a short-term capital gain, less than 12 months. This is unlisted. So what will be the tax rate? 30%. Very good. So on this capital gain, there will be 30%. Okay. Here we are just required to compute the total income and the tax liability. Now, if we look at the tax liability, let's see whether surcharge is applicable over here. What is the total income coming to in the answer? The total income comes to 47 lakh 80,000. So, will surcharge be applicable? Answer is no. Are we clear? Okay. Let us look at the next provision then. Next is the income of the non-resident sports person or the sports association as we may call it. Okay. So for that, we have again a specific provision applicable under section 115BBA. There's a specific provision which is applicable in respect of the non-resident sports person or the sports association. So 115BBA provides a tax rate in that particular respect. What does it provide? 115BBA says that in respect of this, there will be tax rate of 20% under 115BBA. And who is a non-resident sportsman? So if he derives the income from the participation in any game in India, other than the crossword puzzles, horse races, he derives the income from the advertisement, or contribution of any game articles or sport articles in the newspaper, magazine or journals. In respect of non-resident sports association, any amount guaranteed on games or sports played in India. Or in respect of a non-resident entertainer in respect of a performance in India. Now these should be in respect of the non-resident sports person which is there, or a non-resident entertainer which is there who is not a citizen of India. So in that particular case, it will be 20% on gross basis. The TDS will also be there under 194E at the rate of 20% on the gross basis plus surcharge and cess. Okay. Now, whether umpires and referees are the sports person, the court has clarified that the umpires and referees are not sportsmen. Therefore, the TDS for them will be under 195 and not under 194E because these are not professionals or technical person who render the, these are not the sportsmen but the professionals or technical person. So TDS will be under 195, not under 194E. Are we clear? Are we clear? Yes or no? Let us look at the question for this. And these are not required to file the ITR if they have only this income and the TDS is deducted under 194E. Smith, a foreign national and a cricketer, came to India as a member of Australian cricket team in the year ended 31st March 25. He received 5 lakh for participation in matches in India. He also received 1 lakh for advertisement of a product on TV. He contributed articles in the newspaper for which he received 10,000. When he stayed in India, he also won a prize of rupees 20,000 for horse racing in Mumbai. He has no other income during the year. Compute the tax liability of Smith for AY 25-26. Yes, what shall be my tax liability? Yes, correct, Ruchita. So here it will be on the income from the participation in matches, advertisement and contribution of articles. This will be taxed at 6 lakh 10 at 20% under 115 BBA. Horse races 20,000 will be taxed at flat rate of 30% under 115 BB. And plus there will be cess, so the tax liability comes to 1 lakh 33,120. Are the above incomes subject to the TDS? The answer is yes. Received means net of TDS? No. This is gross of TDS. You can take an assumption. So these are subject to TDS. 6 lakh 10 is subject to 20% under 194E. Under, for the horse races, this is subject to 30% under 194 BB. Plus, there will be education cess. Is he liable to file his return for the AY 25-26? Yes, because he doesn't have only the income under 115 BBA, he has also the horse race income. What would have been his tax liability had he been a match referee instead of a cricketer and pays the tax under default tax regime under 115 BAC? If he is a match referee, he is not eligible for 115 BAA, BBA. So then in that particular case, you will compute as per 115 BAC on this 6 lakh 10,000 and still on the winnings, there will be 30%. Are we clear? Yes or no? Okay, now let us move to the TDS aspect. What are the TDS provisions applicable for a non-resident? So as I said, in respect of salary, you have 192, which is applicable. So even if the employer is a non-resident, employee is a non-resident, if he derives the salary for the services rendered in India, the TDS under 192 is applicable, right? Then you have the TDS on the interest from the infrastructure debt fund under 194 LB, which is 5% plus the surcharge and cess. Then income by way of interest from Indian company or business trust. This we have seen 194 LC is there. We had seen at the time of interest, which is 9% in respect of the money borrowed by Indian company or business trust from a source outside India by way of a long-term bond or rupee denominated bond, which is listed on the IFSC. Then there is non-applicability of higher rate of TDS under 206AA if the non-resident does not have PAN, because non-resident generally cannot obtain PAN in India very easily, right? So if they do not have PAN, then 20% higher rate will not be applicable. If in that particular case, they give these details: their name, email ID, contact number, address, TRC, tax residency certificate, which certifies they are a resident of the other country, and their tax identification number of that country. Then we have section 195, which is applicable for payment made to a non-resident, which says that any person responsible for paying any interest other than that covered under 194 LBLC or any other sum chargeable to tax. So there should be an income chargeable to tax first of all. It can't be that every sum which is paid is subject to 195. Let's say, for example, if I pay an income which is not deemed to accrue or arise in India, then it is not something which will be on which the TDS will be there. So it has to be a sum chargeable to tax. To a non-resident or a foreign company is liable to deduct tax at source at the rates prescribed by the relevant Finance Act. So the TDS will be deducted as per the rates of the Finance Act or the rate under the DTAA, whichever is beneficial to the assessee. There is no prescribed threshold given. Unlike 194 JC, there is threshold. Here there are no threshold. The payer can be a resident or a non-resident. So a foreign company making a payment to another non-resident, still it is required to deduct the TDS under 195. So let's say, for example, if a foreign company pays the interest to another foreign company, the interest is deemed to accrue or arise in India because the monies were used for the business in India. In that case, the non-resident, one foreign company is required to deduct the TDS under 195. Okay, and this is irrespective of whether the non-resident has a residence, place of business or business connection in India or any other presence. The TDS has to be deducted at the time of payment or credit, whichever is earlier. And in case they want that the TDS should not be deducted because income is not chargeable or they are not able to identify what is the income chargeable to tax, they can apply to the assessing officer. The payee can apply to the assessing officer for grant of the lower deduction certificate or no deduction certificate. And the AO only after examination will give that. Or the payer can apply also for the lower deduction certificate for the pay. Plus here, the payer before making the payment has to issue the remittance certificate and a CA certificate in Form 15CA and Form 15CB. Are we clear? So that is basically section 195. Okay. Any questions, any doubt? Yes or no? Yes, is this clear? Okay. Next is income from units of mutual fund or specified company. The TDS is under 196A, which is 20%, or the rate under the DTAA, whichever is beneficial. Income from units under 196B, the TDS rate is 10% in respect of plus surcharge and cess in respect of income in units. In case of the long-term capital gain before 23rd July, it is 10%. After 23rd July, it is 12.5%. Income from foreign currency bonds, this we saw for the ADR, GDR. FIIs, we also saw that. So these are the TDS rates which are applicable in respect of payments made to a non-resident. Okay. Now let us solve few more questions over here from your module itself. Okay. Atlant Italy, a company incorporated in France, was engaged in manufacture, trade and supply equipment and services for GSM. No, not this one, sorry. Singtel Limited is a company incorporated in Singapore and 55% of its shares are held by Godavari Private Limited, an Indian company. Singtel has its presence in India also. The details relating to Singtel for previous year 25-25 are here under. Fixed assets are given at depreciated value. Intangible assets are given. Other assets as per books of accounts are given. Income from trading operations are given. This includes income from transactions where purchase are made from AE and sale to unrelated party. Income from transaction where sale are to AE and purchases from unrelated party. Income from transaction where both purchase and sale are from AE. Interest and dividend from investment, number of employees and the payroll expenses. Determine the residential status of Singtel if during the financial year 24-25, 8 board meetings were held, 3 in India and 5 in Singapore. So first let's identify whether this company has the active business outside India. So what is the first test? Passive income is less than 50% of the total income. Now what is the total income first of all here? No, it's not 75. Yes, Jay, 110. Very good. How did you arrive at 110? Yes, very good. So this is 25 income from trading operation. This is in India and this 50 is in Singapore. So this is 75 plus interest and dividend 20 and 15. So this comes to 110. This is my total income. Now what is my passive income out of this? What is my passive income out of this? 50, right? Which is 15, 5 plus 10 and this is 35, which comes to total 50. 50 divided by 110, it comes to 45.45%. So this is less than 50%. Satisfied? Second, less than 50% of the assets are in India. So what is the value of the total assets that we have? Yes. So 610 crores is the Indian asset. Yes. And 210 crores are in India. So which comes to 34.43%. Yes. 120 plus 80, 50 plus 200 and 40 plus 120. This is 210. This test is also satisfied. Then number of employees in India and the total employees. What is the total number of employees in India and outside India total? 43.75%. Yes. The number of employees in India are 70. Total employees 160. So 43.75%. So even this test is satisfied. Last, the payroll expenditure test. Now, if you look at the payroll expenditure, it is 8 and 12. 40%. So even this test is satisfied. So if the active business outside India test is satisfied, what will happen? Yes, if the active business outside India test is satisfied, then how will you determine the residential status? Yes, Suchita. The poem shall be presumed to be outside India if majority of the board meetings are held outside India. Now, how many meetings are held in India and how many meetings are held outside India? Total 8 meetings were conducted, out of which 5 were held outside India. So, majority of the board meetings are held outside India, and therefore in that particular situation, this will be a non-resident company. Okay? Fine. Any questions, any doubt? Okay. Next, Mr. Meshas Global Airlines, incorporated as a US company, operated its flights to India and vice versa during 24-25 and collected charges of 125 lakhs for carriage of passengers and cargo, out of which 65 were received in New York in US dollars for the passenger fare booked from New York to Mumbai, and the total expenses were 95 lakhs. Compute the income for the foreign airlines. So here 44 BBA will be applicable. What is the presumptive rate? 5%. Yes. 5% of the fare booked from India to outside India and from the fare booked from New York to Mumbai and received outside India. So how will you calculate? What will you include here? So 5% is on amount paid or payable to the assessee on account of carriage of passengers, livestock, mail or goods from any place in India, and received on account of carriage of place from any place outside India. So only 60 lakh, 5%? Yes, very good. On the balance 65 lakh, there will not be any income accruing or arising in India. Yes, are we clear about this? Okay. Any question, any doubt? Okay, let us solve one more question here. Sorry. JJ Limited, a company incorporated in Australia, has entered into an agreement with KK, an Indian company, for rendering technical services to the latter for setting up a fertilizer plant in Odisha. As per the agreement, JJ Limited rendered both offshore services and onshore services at a fee of 1 crore and 1.5 crore respectively. JJ is of the view that it is not liable to tax on the fee of 1 crore as it was for services rendering outside India. Discuss the correctness of the view of JJ. Now see, irrespective of the fact that the services are rendered outside India, section 9(2) says that even if the services are rendered outside India, but these are utilized in India, the fees shall be deemed to accrue or arise in India. Are we clear? So in that particular case, the contention is not correct, and on both the amount, there will be taxability. Jacob, the Smith had won from racehorse. So should 20k after TDS while computing total income and tax liability, like whether gross or net amount should be shown? Gross amount. Jacob, you have to always show the gross amount because TDS is also an income. Okay. Any other question, any doubt? Yes? Okay. Now, one more last point before we close the session is the double tax relief obligation. So, for a resident, if they derive the income from outside India, okay, if the resident derives the income from outside India, then in that particular case, they will have to claim the double tax relief because their income would have been taxed outside India, right? So in that particular case, how do you calculate the relief? If there is a DTAA, then you claim the relief as per the DTAA. If there is no DTAA, then in that particular case, you claim the relief in accordance with section 91, which is a unilateral relief. Are we getting this point? So the relief will be given on the basis of the average rate of tax, which is either the foreign tax rate or the Indian tax rate, whichever is lower. So you will claim the foreign tax credit. Okay. So in respect of that, let us look at one of the questions from the module. So we will understand also in detail. Let me open up the question for you. Yes. Question number 8 from the module. Let us see how do we calculate. Mr. Kamlesh, an individual resident aged 52 years, furnishes the following particulars. Of income earned in country X and country Y for the previous year, India has not entered into DTAA with these two countries. Income from profession carried out in India, 7,50,000. This is taxable normally, right? This is from the profession in India. Agricultural income in country X, gross. Whether this will be exempt in India? No. Only the agricultural income earned in India is exempt from the agricultural activities carried out in India. Agricultural income in country X will be taxable. Okay. Dividend from a company incorporated in country Y. Under which head you will take it? IFOS. Okay. Royalty income from a literary book from country X. 6 lakh. No IFOS. Why IFOS? It's a royalty income. Why IFOS? It will be business income only. Now, here there is one more important point. Let me see who cracks this. Yes. Yes, Jay, very good. Not 80 QQB, 80 RRB in respect of royalty. QQB is in respect of the patents. So 6 lakh on this, you will get a deduction under section 80 RRB. Sorry, 80 QQB. Yes, you're right. 80 QQB. So you get a deduction under 80 QQB in respect of this. Okay. What is the deduction amount? 3 lakh deduction and plus the expense deduction. However, you have to take an assumption that you have brought the amount in the foreign exchange within a period of 6 months from the end of the previous year. So students, whenever the royalty is given in the question, yes or no, you will have to see that whether 80 QQB is applicable in this case or not. Are we clear? So you have to take that into consideration. Okay. So here we will allow 80QQB, which is after considering the expense deduction. After considering the expense deduction. So you will have to first consider the expenses, because here you have royalty income 6 lakh minus 50,000, 5 lakh 50 minus 3 lakh will be the deduction. Yes, Jay, also AMT is applicable if the income is more than 20 lakh. You're right. Business loss in country Y, proprietary business. Whether you will get this loss. Now what they have said, business loss in country Y not eligible for set off against other income as per the law of that country. Does it impact? Yes. Whether you'll get the business loss, will not get? Yes, we'll get, right? And it doesn't impact if the other country allows against the other income or not. We will allow it as per our rules, right? We'll consider as per the Indian domestic law. Rent from a house property situated in country Y, 2,40,000. Municipal tax paid in respect of the above house in country Y, not allowed as deduction in country Y. Will we allow municipal tax paid in other country? Yes, yes, we will allow. And the standard deduction also we will allow. Even if other country doesn't allow, it doesn't matter. So now, if we look at the solution for this particular question, you have the gross annual value 2,40,000. Now we are taking an assumption that the rental income is taken as the gross annual value in absence of any information relating to fair rent or municipal value. Less municipal taxes 10 and minus standard deduction 30%. Then I have income from business, income from literary book 5,50,000, right? I will set off the business loss 65,000 over here against my business income, right? And I will offer it to tax. And then agricultural income and dividend income is my other source. This will give me my gross total income minus 80QQB 3 lakh, assuming the amount has been realized in foreign currency within 6 months of the end of previous year. Here there is no AMT applicable because the total income does not exceed 20 lakh. If the income exceeds 20 lakh, you will have AMT applicable because you have claimed a deduction under 80QQB. Are we clear? So you have to write these points in the examination that the AMT is not applicable because they have not told you to ignore the provisions of AMT. Ma'am, what will be the treatment if agricultural income of 5 lakh in India and expenses related to agricultural 1 lakh, but it is taxable in country Y? You will exempt it. Why? We will look at the provisions of country Y. It's a resident of India, so we will compute the income as per our Income Tax Act. We will not look at country Y. Okay. So now we will compute the tax liability over here for Kamlesh. So he is opting out of 115 BAC that is given. So this is the tax on total income. Now how do we claim the relief? Okay. So this is the tax on total income. There is no surcharge. Now this is very, very important. The relief under 91. Since there is no DTAA between the country India and country X and India and country Y, so therefore we will allow the unilateral relief under section 91 because the income has been taxed in those countries and he has paid the tax in those countries. Now first, to calculate the relief, we will allow each country wise students. You will allow each country wise. So if you go back to the question, you will see there are two countries. In X it is 10% and in Y it is 20%. So we will calculate the relief for two countries separately. Now how do we do that? So first for country X, what are the incomes paid in taxed in country X? agricultural income, 50,000, right? And royalty income from literary book from country X. These are the two incomes. Yes or no? Now, how do you calculate the relief on this? So first I will identify my average rate of tax in India. What is the average rate of tax in India? What will be the average rate of tax in India? Yes. Tax divided by total income 209352, which is this total tax, divided by 12,96,000, which gives me the average tax of 16.154. Now lower of this is 10%, which is the tax rate paid in country X. So I will take 10%. How do I calculate the relief? So on what directly should I apply on 5,50,000? So this 50,000 plus this income of 5 lakh or 6 lakh. How should I calculate? Should I apply on 6 lakh plus 50,000? Should I apply on 50,000 and 5 lakh 50,000? What do you think? On what amount should I apply this 10% to get the credit? Why country's income? But Ruchita, what amount? Should I take 6 lakh as royalty, 50,000 as agricultural income? Should I take 5 lakh 50 as royalty and 50,000 as agricultural income? What is the amount that I should take? See students, credit is given for the tax paid in the other country on that income, which is a doubly taxed income. Yes, Suchita. Yes, Jay. Very good. So if an income has been taxed in both the countries, that is the reason why I am getting a credit of that tax as a double tax relief, so that the income should not be doubly taxed. If it gets taxed in India, if it gets taxed in country X, I should give the credit so that it is taxed only at one place. But what is a doubly taxed income? Is 6 lakh a doubly taxed income? 50,000? Yes, we understand, because India is also taxing it, X is also taxing it. But is India taxing 6 lakh rupees of royalty? No. India is taxing, first of all, 5 lakh 50. 6 lakh minus 50,000. It is giving an expense deduction of 50. Plus, it is also allowing you a deduction of 3 lakh rupees under 80 QQB. So technically, India is taxing only 2,50,000. So I should get credit only on 2,50,000, not on 6 lakh or not on 5,50,000. Are you getting this point? So we will take doubly taxed income here, royalty, as 2,50,000 and not 5,50,000 or 6 lakh. Because the amount deducted under chapter 6A is not doubly taxed as per this R.N. Jhanji case. So the lower of these three, 10% on 3,30,000 is the FTC which is allowed under section 91. Now coming to the country-wide, average rate of tax is 20%. India's average rate of tax is 16.154%. So this is the lower. Now again here, what is the doubly taxed income? So first of all, we had income from house property. Here, should we take 2,40,000 or should we take 1,61,000? 1,61,000, because you are getting the deduction of municipal taxes, you are getting the deduction of 30%. So we should take 1,61,000. Then you have dividend income 1,50,000. That we will take fully. But you also have a business loss in country Y. Should we reduce it? Should we reduce the business loss? Yes, because that is reducing your doubly taxed income. So I will allow the reduction of the business loss before I calculate the FTC. So my doubly taxed income is 2,46,000. On that 16.154%, which is 39,739, and this is the total FTC which will be allowed. Are we clear, students? Okay. So this is how you calculate the foreign tax credit. These are the standard questions which may be asked in the examination, and you should be writing proper notes to this, all of that we have discussed. These notes are mandatorily to be written. Okay. So with this, we'll stop here for today and we meet in the next class on Sunday, which is last class for your LBRC on the statutory updates. Fine. So thank you so much. Yes. Thank you. Good night. Discuss on Sunday? No. Safe harbor, it might have been covered in transfer pricing itself. We'll only discuss the statutory update. Will there be trust revision? Jacob, it is already done in the previous class. Please watch the last revision lecture. Yes, thank you so much. Please close the session.